suffer through the post-housing bubble bursting, I guess the bursting of the housing bubble that's given us this economic malaise, this malinvestment that's being worked off. Let it be known that this is probably the third bubble in a row created by monetary policy. We remember the tech stocks of the 1990s. Then we had the housing bubble. Actually, that was the second. And now we're in the midst of a commodity bubble that critics of the Federal Reserve say is all due to a massive increase in easy money. Well, perhaps the nation's leading critic of the Fed is the congressman and author, Ron Paul. His latest book is called End the Fed, talking about the Federal Reserve, and he joins us now. Congressman Paul, welcome to the Jason Lewis Show.
Thank you. Good to be with you.
Yeah, same to you. Now, this is something that's near and dear to your heart, and there's no question that a number of critics of the Fed would point to easy money, at least I would, and I think you would, as the result of... or I should say, has one of the culprits in the housing bubble. The question is, what system should replace it? And that's what you address in your book.
Well, what we should replace it with is essentially nothing. When it comes to central banking, you don't need a central bank. What you replace it with is sound money, and we allow the markets to set interest rates. We don't believe that we should have interest rates fixed. It's sort of price fixing. And the Fed is always giving bad information. Interest rates are very, very important in a market. If the people save, interest rates go down, and then the producers and the investors know that there's low interest rates and there's capital there. Mm-hmm. But for the last 10 years or more, 20 or 30 years, we've essentially not been savers, we've been spenders. But lo and behold, interest rates are low. And the only way that could happen is if the Federal Reserve was creating money out of thin air, so they sent all this false information that there was a lot of savings, a lot of capital available, and then they overinvested. They make mistakes. They're responding in a logical fashion, but illogically because they're not taking into consideration the fact that the Fed has created artificially low interest rates. So that's a very serious mistake.
That's effectively the von Mises view, the Austrian school view, that when you create these sorts of easy money policies, which we certainly have had with the federal funds rate hovering near zero now for a year, and before that, throughout the first part of this decade, creating the bust and boom cycles, that people see these artificially low interest rates. That's an excuse for more loans, and in many cases bad loans, an excuse for malinvestment. But you got to be... In addition to monetary policy, if you take a look at housing policy, we had some crucial fiscal and regulatory issues that drove the housing bubble as well. Fannie and Freddie, you had the Community Reinvestment Act, you had the housing quotas at HUD. Without those, some people say the housing bubble wouldn't have been as bad either.
I think that's true. I think that made it worse. I think it was a combination of low interest rates and artificially created credit, along with the pressure by the Congress to make bad loans. It literally would penalize banks if they did what they called redlining. Oh, no, you have to give loans to people who don't qualify. Right. It was absolutely bizarre of what they were doing. And, you know, when the prices were going up and there's a boom part of a cycle, everybody feels pretty good about it, and they don't worry about the consequences. But it's sort of like when you're out on a drinking party, you figure, well, I'm not going to worry about my headache the next morning. But now we have our headache, and it came because we were overdoing it. It was excessive, and it's very painful.
Well, it's a classic malinvestment, to use an Austrian phrase. I mean, it is when you have these misguided signals. We're not when it comes to interest rates. You want interest rates to be determined by supply and demand, not any artificial lever. And when you had all the fiscal and regulatory incentives, the moral hazard, we made bad investments. Bad investments are those that don't return a profit that allows you to service the debt. And it's been my view for quite some time that had we not bailed out Bear Stearns, had we not tried to reflate the bubble, with money's even easier now, as you well know, Congressman. The Fed's balance sheet has doubled. Had we not done that, we would have had a very sharp correction, but we'd probably be out of it by now.
That's right. So we've done exactly the wrong thing. What we should have done is allow the market to liquidate bad debt and get rid of the malinvestment. But instead, our policies now in Washington are to try to keep the prices of houses up, try to stimulate building of houses. And there's 1.5 million houses sitting out there. The prices need to go down, and that needs to be cleared. People who have some money, the prices have to get down in their price range where they can buy. But instead, we're propping up the prices, and we're doing the same thing. So you can't solve the addiction to easy credit with more easy credit. But on the next bubble, I know the commodity prices are high. I think of that as less of the bubble, maybe a more normal reaction. I think the bubble where the artificial prices are the bonds. The bonds are so high because, the Federal Reserve keeps the interest rates low, which means the price of the bonds go up. So one of these days, these interest rates are going to turn around. There'll be loss of confidence in the dollar, and then there may be if there's a run from the dollar, there'll be a run from buying our debt.
Well, we're already seeing a weakening of the dollar.
That's the major problem that we face now.
No, a run on the dollar would be catastrophic, and we're seeing a weakening of the dollar. Plus, the Fed has set up a system where it's easier for bankers to say, I'm going to borrow with the federal funds rate at 0, buy a 2 or 3 year Treasury bond, give it right back to the government, and I'll make money on the spread. Who needs to lend to private business?
Yeah, why take the risk? I mean, and that's why. What are they doing? Reporting record profits, and we're supposed to all feel good about it. And it's all just insider trading. They put people who do insider trading on the private business, but this is all insider stuff. The Federal Reserve, the big banks, and easy credit to them, and they people who might be able to use this credit. They're not getting these loans. The confidence is not there. There's a lot of reasons why they're not getting the loans, but there's still a lot of people making a lot of money. I mean, the real crime is when you see huge banks and companies like Goldman Sachs making not hundreds of millions, but literally billions of dollars. I mean, Goldman Sachs has something like $21 billion that at the end of this year will be passed out in bonuses.
Well, you think that's
it's not
money.
like they produced goods and services.
Well, let me tell you something. You think that's money? Wait till Al Gore's carbon credit exchange is implemented, and you've got these same bond traders now trading carbon credits, which will go up in value every year as the allowable emissions goes down every year.
Yeah.
That is
the same people too. It's they make money on the when the bubble inflates, and then they're the first in line for the bailouts.
What though would give you confidence that going to a more private banking system backed by gold would be any less volatile? For instance, if you take a look at where the price of gold has gone in the last couple of years, what is it, doubled? I think it was $500 not long ago. If you were on a traditional gold standard, then people would start turning in their dollars for gold, and you would have rampant deflation in the middle of a downturn. Isn't that why William Jennings Bryant was bemoaning the fact we were crucifying the economy on a cross of gold?
Well, yeah, but I didn't accept his arguments. I mean, he actually, back then, he wanted to inflate with the silver. Can you imagine? Yeah. He wanted more silver, and today all we want is computers. We don't even print the money. We don't even waste time printing to put money in. We just create the money with computers. So, no, it isn't the gold that's unstable. It's the paper in relation to gold. But you will see a lot of ups and downs, especially when most people still think in terms of the dollar. But gold long term is very, very stable and maintains its purchasing power. And it's the dollar that's unstable.